Welcome back to Just Some Perspective podcast. I'm your host, Mosh Rahman. So, the economy is in a messy spot. I think we all know with recent events of layoffs and recent news of markets and crypto and everything. It's just a shit show, honestly. So, this channel by Mr. Mark Moss, who who has a lot of experience in tech and finance, is going to break down why the economy is collapsing, but the markets are still booming, and why those things are correlated and have always been. So here we go.
The economy is crashing, but markets are at all-time highs. You see it everywhere. Layoffs stacking up, credit cards are maxed out, people drowning in debt. Economists are screaming this is going to be worse than 2008, and honestly, it makes sense. When the real economy looks this bad, markets should crash. They always crash, right?
Yeah.
But what if they don't? What if something fundamental has changed? Something that's keeping markets alive even as the economy collapses underneath it. Now, I've been building and selling tech companies for decades through multiple boom and bust markets. Today, I'm a partner at a leading Bitcoin venture fund, and in this video, I'm going to show you the one chart that we're looking at that proves this market has disconnected from reality and what we're doing about it, and so should you. So let's go.
Yeah, it's true. All throughout history that I know of, the market has reflected the economic state. So if it's down, the economic state is down. If it's up, right? So the market has always been the indicator, and by that I mean the stock market, stock index, whatever, has been the indicator of the economy as a whole. So if those two things are now becoming more mutually exclusive or whatever, or not like dependent on each other, that is a whole new game. So I'm interested to see how he breaks this down.
Economy's crashing, but the markets, all-time highs, right? You feel it everywhere. Friends are getting laid off. Groceries are costing more every week.
Knock on wood. I'm praying for all those who've been affected by layoffs anywhere and everywhere, especially those who are friends of mine or family of mine. I know it's tough. I can tell you I've been through that many times. In my career, I've been through so many different opportunities, but I've always bounced back. Okay, and everyone can bounce back. Keep your head up, stay positive, provide support where you can. Don't lose hope, and eventually you'll see results. But yeah, it's tough out there for everyone. So I'm praying for y'all.
Credit cards are being maxed out. People are just trying to make it to the end of the month. And meanwhile, Wall Street's celebrating new highs, record profits. Wow. CNBC's talking about,
if that's not the epitome of the rich getting richer, the poor getting poor, I don't know what is. And that is insane. And I understand it's unfair. It sucks to hear, but I don't know. It's kind of the world has always been this way. I don't know what to say.
Like everything's fine. It doesn't add up. Every economist out there keeps calling for a crash. Some say worse than 2008. And when you look around, it's hard not to agree. Because the real economy, the one you and I actually live in, it is breaking apart. You're watching the middle class get squeezed harder than ever. And somehow the market keeps celebrating like everything's fine. And all of the experts keep saying, don't worry, it's just noise. But it's not just noise. It's the sound of a system splitting in two. Here's what's really going on. There's the physical economy. That's the world you and I actually live in. And then there's the financial economy, the world that runs on liquidity, on algorithms, and belief. Now, those two used to move together.
That's crazy. Yeah. And I mean, I've heard of two-tier systems, like, two-tier policing and in different areas and so forth. But two-tier economy, and there's a physical one and a fiscal one, not a real one. That's crazy, but that sounds very realistic. That sounds like it's accurate. I mean, because I understand markets sway just on pure speculation all the time. If I'm not mistaken, I'm certainly not an economic expert. I'm not a stock expert at all. I'm definitely not a financial advisor, but I've heard all the time that they sway and go up and down on pure hype, just pure hype, no real reason, and maybe it's because of people's sudden belief in something. And there are always things in the market like, what's that, Labubu, that weird doll thing that has become a craze out of nowhere, and then but all throughout history it's been craze buys and uncraze. So anyway, I digress. Let's continue.
Used to work together, but now they're breaking apart. And that disconnect between Main Street and Wall Street, it's not just a glitch in the system. That's the final phase of the system. Okay, so let's start with the world that you actually live in, right?
Yep.
Not the one that CNBC lives in, because in your world, things feel light. Groceries, right? They cost more.
So
Credit
expensive.
cards, they are going up. Maybe
Regular, I don't think it's possible to get a full week's of groceries for less than $50 anymore. I really don't believe so. You'd have to penny pinch like crazy to do that. And yeah, everything's up. I mean, I was just thinking about this. I don't think a lunch for less than $10 exists anymore. I really don't. Not a solid lunch. I'm not talking about like crap burgers from a fast food joint or something, you know. But like a solid, just basic lunch with everything you need, sandwich or whatever, $10 minimum everywhere. You know, even Starbucks like $5 now for a basic frap or something. So everything's up. I by myself I can't get groceries for less than $60-$70 to be honest, and that's on the conservative side. I usually go a way above that because I just you like quickly buy like you buy something like on the whim, right? And just reflex, whatever it's called, and and you just can't help it. Like I need this bag of chips, I need this popcorn. So yeah, I leave a little room for that, but it is crazy. And even if you're a high income earner, it's still crazy. You just end up spending more, to be honest.
be getting maxed out. It seems like every week another big company announces layoffs. And yet somehow, as I said earlier, the markets are still at all-time highs. Let's break all this down because the real economy, the one that you and I live in, is quietly falling apart underneath it. Right? You can see it in companies that are supposed to be bulletproof. The ones that make the stuff you buy every week. We call them consumer staples because they're staples, because we need them. But look, Clorox.
You gotta have your protein, your milk and eggs, as they say. The whatever you have to make for dinner, which is usually some kind of a meat, protein based meat, and some kind of carbs like rice and whatever. So vegetables, fruits. I mean, water. You basically need all that stuff. You could get away with no snacks for sure if you're really conscious like that. But you definitely can't get away from no food at all. No meat-based food or protein-based food or rice or anything like that. You absolutely do need those.
Is down nearly 40% from its 2022 peak. Kraft Heinz is down 30% just this year. Procter & Gamble, the definition of a boring, reliable company, is down 20%.
That's like the oldest company. Like it goes back 100 plus years. I forgot what they even do necessarily, but I know they've been a staple in the economy forever.
General Mills has lost more than 1/3 of its value.
No more cereal eater over here. No more cereal eater. Used to eat cereal all the time. Mostly General Mills cereal. I think I stopped eating cereal years ago and been mostly coffee, protein shake, that kind of thing, and haven't looked back.
Just this year. Now, these aren't luxury brands, right? They're not tech companies.
Nope.
They sell soap, cereal. They sell cleaning supplies, like the most essential stuff in your pantry. And if they're collapsing, it tells you something must be breaking, something at the foundation. Now, meanwhile, the American consumer, that's the engine that powers the economy, that's powered the economy for 80 years, they're completely tapped out. Credit card balances hit a record whopping $1.3 trillion this year. I mean, that's not spending on vacations or upgrades. That's people using plastic just to get by. Now, the average interest rate, over 24%. It's the highest in history. Delinquencies, they're now the worst that we've seen since 2012. The median checking balance is now down about 40% since 2021.
Median average net worth. I don't know if that's correct. If that means average or I know median is not necessarily average. No, I believe that's what the mean is in terms of math. But yeah, which is total sum divided by the number. But median is basically in the middle of the highest and the lowest. So it's dropped 40%. That's crazy.
That means savings are gone. That means people are floating their lives on revolving debt. Now, we see the same story with cars. Auto loan delinquencies just hit their highest level since the 2008-2009 crisis. Repossessions, they're up 20% year over year. The average new car payment is now over $740 a month. I mean, that's insane for a car. And when you can't borrow anymore, what happens? Well, when there's no more buyers, demand collapses, things go down, right? That's why we're seeing layoffs. That's why we're seeing it spread everywhere, not just in tech. UPS cut nearly 50,000 jobs. Ford and GM let go of thousands. Starbucks axed 5,000 corporate roles. Target shut down stores. They cut management. Even Amazon, even Nike are back to efficiency rounds. Now, when companies that depend on everyday spending, when they start cutting workers, it's because people have stopped buying. Now, real wages, they're also flat. The savings rate, it's near record lows. Mortgage delinquencies are up 20% year over year. Nearly half of renters are now spending over 30% of their income just to keep a roof over their head. I mean, this is part that people on Wall Street don't want to talk about, right? They don't want to talk about the physical economy and how it's...
Of course, people on Wall Street don't want to talk about. They're about as far removed from the average American consumer's life than I think can be. And yeah, if your whole life revolves around the entire market and how stock prices go up and stock prices go down and how it impacts the economy and your wallet, you most likely have very little interest on the average American and the most median household income, how they afford basic stuff anymore. But everything across the board is up, and that's not good. But unfortunately, the middle class, like you said, is getting squeezed the most, especially with these layoffs and stuff. But yeah, if things are down and people are buying less, that also impacts the upper echelon economically the companies, and they have to let go of people and so on and so on. But anyway, he's doing a great job explaining it. Great video.
It's actually seizing up. The middle class, they're the group that used to fuel growth through the spending. They're now running on fumes. The model that worked from 1950 to 2020, growth through consumption and credit, it's all breaking down. The system can't expand anymore because people holding it up, they're broke. But yet the markets, they don't notice. The markets keep going up. So how is this possible? Well, because there's now two economies. There's the one that you live in and the one that Wall Street trades on. And only one of them still matters to the system. And this is where the story splits in two. We have the real economy that's clearly breaking down, and then we have the second economy that looks unstoppable, right? The old rule was don't fight the Fed. The new rule is don't fight the narrative, because that's exactly what's running the markets right now. It's all running on belief. If you just watch the headlines, the S&P 500 looks like it's booming. But if you pull up the equal weighted version where each company counts the same, you're going to see that it's barely even moved. It's not 500 companies that are rallying, it's 5. Reuters said it straight. They said, quote, a relatively small number of large stocks are propelling the market, end quote. And those are the...
Yeah, let me guess. It has to do with Amazon, Tesla, SpaceX, Facebook, AI, ChatGPT, NVIDIA. These are the biggest ones that I'm aware of, and maybe some major cryptocurrencies, but wow.
AI giants, we're talking NVIDIA, we're talking Apple, Microsoft, Amazon, Google, Meta, Tesla. By October 2023, just 7 companies made up about 1/3 of the entire S&P 500. NVIDIA alone was close to 8% of the whole index, the largest weight of any company that we've ever seen. That means that when NVIDIA moves just say 1%, it can move your entire retirement account. That's how narrow this really is. And it's all built around a single idea: artificial intelligence. AI has become the lifeline of the entire market. Every earnings call, every headline, every valuation, every story ties back to AI. Now, at one point this year, roughly half of all S&P 500 gains came from a handful of AI-linked names. Half, not 75, not 60, half. I mean, that's massive for an index that size. And here's the wild part. AI isn't just a story. It's becoming the new stimulus. Total capital spending for S&P companies hit around $1.2 trillion this year, the highest since records again back in the 90s. Almost a third of that is coming from the same 9 companies building AI infrastructure. So even when consumer demand is flat, corporate investment in AI keeps GDP expectations alive. That's why valuations stay up, not because of today's profits, but because of tomorrow's hope. You see, Wall Street isn't trading reality anymore. It's trading belief. The index isn't pricing current demand. It's pricing a story about future productivity. Capital doesn't need consumers right now. It needs conviction. It needs belief.
Yeah, when you have a separate economy and it's held up merely by belief and speculation, that is crazy because that can change in an instant. And I didn't realize that AI powers the economy to that level already. I thought we were a little while away from that, but as he mentioned, it already is made its way to the infrastructure economic level. That's insane. And I don't want to keep beating a dead horse, but we all know AI is here, it's coming, it's here whether you like it or not, and we have to make the use of it. And yeah, there's the fears of replacing jobs or whatever it is, but we're in such an infant stage of this that we don't have no clue the actual impact of it yet. We don't know, but yeah, so it's a major part of the economy already, and like you said, there's 2 economies. It's not even the world we just live in only. It's the whole separate one we don't even aware of, and so that's crazy.
As long as investors believe that AI is the future, then money's going to keep flowing in, even while the real economy struggles to breathe. That's the synthetic economy. It's not driven by spending. It's not driven by production anymore. It's driven by story. And for now, that story's powerful. It's powerful enough to keep the whole illusion alive. But stories can only sustain belief for so long. But what happens when that belief turns into policy? What happens when markets stop being free and become fully fiat? Well, for 80 years, the formula was simple. You go to work, you earn money, you spend it, and that spending drives the production, which then creates profits and markets, consumption-powered growth. But now the whole sequence has completely flipped. Just in October, the Fed didn't just cut rates again, they also hit pause on quantitative tightening. That's central bank code for we're not going to drain liquidity anymore. And liquidity is what lifts the asset prices. The BIS even said that global financial conditions eased this summer because equities went up and credit spreads tightened. In other words, the markets themselves become the stimulus. We're now in a loop where bad news means more cuts, more liquidity, and then higher prices. So bad news is kind of good news. Weak jobs data, market rallies. Slowing economy.
In other words, up is down and left is right. It's like all backwards.
More easing. Every data miss just feeds the next leg higher. That's the inversion that we're seeing. The economy used to drive the markets. Now the markets drive the economy. Today, corporations are the biggest buyer of their own stock. About $1 trillion in buybacks just this year alone. Not consumers, not foreign investors, companies using cheap capital to push their own stock prices higher. Now, the Fed provides the liquidity. Wall Street channels it through corporate balance sheets, and stock prices keep going up. Even the central bank's researchers admitted.
That is such a cool studio, and you know this dude is a really successful guy who's been doing this for years. I mean, that studio looks like $50,000, $100,000. Just basic, just that setup. The table looks awesome, the background. So this guy clearly is successful financially, and he clearly has a lot of knowledge. He has his own teleprompter, for God's sake. Like, that's not easy to do, easy to obtain. So yeah, I'm gonna start watching him more, but let's see if we can wrap this up.
Programs like the Bank Term Funding Program lowered perceived bank risk, right? It was never about fixing the system. It was never about fixing the fundamentals. It was about protecting consumer confidence in the story, in the belief, because belief itself is now the policy tool, right? Today, just 7 companies control more than 30% of the entire S&P 500. And analysts keep raising their year-end targets because of AI enthusiasm and easing Fed policy. Again, it's not earnings doing this. It's narrative. This is the new model. Belief, liquidity, markets, and production.
Holy shit. That is a crazy model. Belief, liquidity, markets, and production. Man, those are four words that a lot of people usually you wouldn't associate with one another. At least not all four. Yeah, liquidity, markets, production, they technically go together, but belief, that's a that's a whole new realm of economic world that doesn't even make sense. But it's the first time I've seen that. So
That's why I call it a fiat market, right? Because just like our money, it's backed by confidence, not collateral.
true.
As long as the story holds, the system stays alive.
Yeah, if anyone knows about the fiat system and the U.S. economy, the dollar is not backed by actual resource like it used to be in the gold standard before we came off of it in the 70s. So now the only thing propping up the entire economy, so you could almost say money is not even real because it's just based on the guarantee that the government says its value is based on this. So we're we're spending our whole life making this money that is not even backed on a real resource, and it's almost imaginary, and it's only backed by the belief by the government, by their word saying it's legit.
Which is why I've been making video after video for the last at least several years, warning the danger now isn't a crash down. It's not a deflationary crash that most people are thinking of, but rather it's a crash up. Too much liquidity chasing too little substance. We have basically capital flooding into the last narrative standing. And while everyone keeps waiting for the crash down, what we're getting is the crash up, right? It's the grand finale of the belief era. Because
Now that's a word. Those are two words I've never heard together ever before either. Crash up. That's totally new. That is pretty interesting use of words there, and especially economic wise. So I haven't heard anyone else even mention that really. So this guy's he's kind of making noise, and he's kind of he could be prophetic here, to be honest. And I believe he knows what he's talking about. I mean, it's hard to be that convicted and that knowledgeable about a topic if you don't know, if you didn't learn. So for sure, I bet he knows what he's talking about. I'm not no expert that I wouldn't rely 100% on what anyone says, but that's a really unique way of looking at it.
when you look at what's actually happening right now, the Fed's cutting rates, they're halting QT. Liquidity is flooding back in, and we have trillions of dollars in buybacks happening. So it's hard not to see where this goes next. The same forces that inflated the bubble, they're now trying to keep the bubble alive. And when a system runs on belief and liquidity, the end never comes as a crash down, all right? But this isn't some magical fairy tale ending. Let's be clear about this. This thing has two failure points. First, there's a liquidity crisis that could potentially happen if the Fed decides to pull the liquidity away, right? Yeah. Then the engine starts to sputter out. We just saw how fragile it is. The Fed had to pause its balance sheet runoff to stop liquidity from evaporating. The BIS even said, right, the market itself has become the transmission mechanism. The second risk is the belief crisis. If the AI narrative cracks, capital will fall back to reality really fast. Now the Mag 7, they control 30% of the S&P 500, right? So that's highly concentrated. We haven't seen that since the dot-com era. Analysts literally raised their 2025 targets to 6,400, 6,500 just on AI optimism alone, right? But if this story breaks, if AI earnings disappoint, or if productivity promise fades, doesn't materialize, the entire layer of belief collapses. But before either of those failures hit, we're likely to see at least one last surge, in my opinion. Some may call it a melt up. I call it a crash up. Either way, we can see it right now. Right? Liquidity's rushing back in. Buybacks are running at 1.1 trillion. The risk appetite's completely exploding. We just saw nearly 6 billion pour into crypto ETFs.
Holy shit. And yeah, and crypto's having a rough week, to be honest, or if not a rough few weeks. The market is not good at the moment. So if you have crypto, do your due diligence and make the best move you can make. But it's definitely been affected. So it's pretty insane. So I hope it gets better. I mean, usually things bounce back, but this man is going into detail and blowing my mind with things that I never even thought of. So yeah.
In a single week, right? This is how late cycles behave. Policy loosens, flows accelerate, the leaders drag the index higher, and everyone pretends it's a new boom. This is the window of opportunity. And the thing is, the winners won't be the ones that are fighting the system. They're going to be the ones who understand it's fiat And they're going to position themselves outside of it because the fiat market runs on faith. Bitcoin, it runs on proof. Bitcoin supply, it doesn't change because of a meeting in DC, right? It's fixed. 21 million coins locked by code. And the hash rate, the hash power, the mining power, real world energy securing it, and it's at an all-time record high, right? That's why it matters. It's not a story. It's not a narrative. It's backed by math. While the belief economy melts up, I'm looking towards the next system, right? The one that's built on proof, not promises. Because every time a fiat system ends, a new base layer rises from the ashes. And this time, the base layer is Bitcoin. Okay, so here's where we're at.
Wow. So big Bitcoin proponent there, at least we can say. That was an amazing video, and I'm going to look into it more. Mark Moss with just short of 800K subscribers, so clearly he knows what he's talking about. So yeah, we're going to leave it here. If you like this video, please hit the thumbs up, like, and subscribe. How do you feel about the economy? How do you feel about the markets? Do you like how he's breaking it down, and how that there's a whole separate economy based on strictly belief only, and it's completely outside of the economy that we live in? Do you see that being reasonable? Do you see that being a load of BS? Or, I mean, do you think there's hope left in the economy? Comment below, let us know. If you like this video, please thumbs up, like, and subscribe. And with that, this is Mosh. Remember, it's just a perspective.